But Dr. Phil is going to host the meeting today, and I and William is going to, I call William his English name, is going to introduce himself. So I started investing in the individual stock market in the month of March 2020, and during the pandemic. And also I started a YouTube channel, this YouTube channel 2 months ago. And so I'm retired from the New York City Department of Sanitation. And so I am home and I am investing and loving it. Before we go any further, I want to introduce William, and then I'll introduce Phil, and we'll start the program. William, take it over.
Hello, everybody. My name is Guillermo Bermudez. I have a YouTube channel called Finance ABCs. I started it in June of last year, 2020. And I've been in the financial services industry for 30 years and worked in broker-dealers, banks, commercial banks, and international banks. And I have learned along the way by making mistakes, and some of those mistakes, drew powerful lessons. And so I also am an author. I wrote a small book called Saving for Retirement Made Easy. It's available in Amazon. And so we're trying to talk and share ideas. I met Lucien Rojas and his YouTube channel, Financial Empowerment with Brother Ro, and it really resonated with me because, he has had remarkable success, and he's very, very transparent, and I have learned from his channel very much. And I hope to contribute to him. He learns from my channel, and I learn from him, from his channel, and we all are on a journey together, and we are embarking on this fabulous journey together, and we're sharing our trades and our most humble recommendations to you so that you can invest alongside us and make money for yourself and for your financially secure retirement.
Wonderful, wonderful, William. And I also want to introduce Phil Reed, who is the CEO and founder of Phoenix National Network. And Phil is a good friend and brother, and he will manage this meeting today. Thank you, Phil.
Yes, thank you. Thank you so much, Apostle Rojas. Yes, my name is Philip Reed, and I am the owner of Phoenix National Business Group, which will also have a platform, Phoenix National Network. Primarily, we are a marketing company, and we partner with other entrepreneurs and other business facilities to help them promote what they do best. And so we have a platform on Roku and Amazon Fire TV, Phoenix National Network, where you can go and you can see all of our programs. This is one of the programs that will be broadcasted there as well. We have all of Brother Ro's broadcast on YouTube on there. So if you want to see the collection of everything, you can go there and see it as well, along with other business professionals who want to share what they do with you. So I appreciate you allowing me to share that, Apostle Rojas. And you could go to Phoenix National Network for more information, or you could go to phoenixnationalbusinessgroup.com for more information as well. We'll place that in the chat as well. Thank you so much.
Dr. Phil, appreciate it. You, my friend and brother, and I really cherish relationship. I take relationships serious. Someone said relationship, they are greater than accomplishments. And when you have solid, good people, you want to cherish those relationships. All right, we want to get into the program today, and Willie and I will really exchange and share stuff, and Willie, I would say he's more experienced than I am when it comes to investing, but there's a power of investing. As a matter of fact, investing and versus saving. Saving is good. We save for what we call a rainy day, or we save to have an emergency fund in the times of trouble. But somebody would put it this way, and this was from a billionaire. He said, you don't ever become wealthy by investing in a savings account. Let me draw a case in point. There's something called inflation, and there's something called buying power. Let's say a 225-year-old in 1970 had $40,000. Do you know with $40,000 in 1970, you could have bought a house in Brooklyn? Cash. Let's say John Doe, he bought a house for $40,000. And John Hancock took the $40,000 and said, you know what, I'm not buying a house. Mortgage, repairs, problems with tenants, whatever his excuse was. And he took the $40,000 and put it in a safe. 50 years later, they both 75. John Doe house is worth $800,000 because he invested in asset and not in a liability. His price went up with, as a matter of fact, it beat inflation. It beat the value of the dollar. So now John Hancock has his 40,000. Surprisingly, that's not even enough to pay down on a house now. So you see, when you save, your money is like what you call time decay. You're losing buying power. But if you invest it, see, the talents, the three talents, the one that invested again 500 more, 1,000, 100% more. The one with the two gained 100% more. The guy who saved his own. He wasn't a dishonest guy. He wasn't a bad guy. He just saved it. And what happened? He lost it because he didn't want to take a risk. And so too with investing, people don't want to invest. They're scared. And as they're saying, scared money don't make money. All right, let me go into the slide, the PowerPoint here, and let's start right now. Okay. All right. Yeah. Okay. We're talking here about the uncertainties of life, and I get all my guidance from the good book, which is the Bible. And I want to just bring you quickly, I don't want to preach to you this morning, but I want to bring you a scripture from Ecclesiastes chapter 11, verses 1 and 2. And this is from the New Living Translation. And hear what it says. And this is a book of wisdom, and the Bible is the book of life, man. Send your grain across the seas, and in time, profit will flow back to you. But divide your investments among many places, for you do not know what risks might lie ahead. Okay? So, so let's get back to, yeah. Right, so you see that scripture? So now it talks about diversifying your portfolio because you know what risk lies ahead, right? Cash your on the seas, your grain on the seas, that's trading. See, we talk about the Wall Street Journal and Yahoo Finance and all these different things. The Bible, man, that's the book. So when we hear people talk about diversify your portfolio, that was written thousands of years ago. Invest in different places. So that is powerful, all right? And that's one of the things I need to do with my portfolio, Willie. I need to be more diversified. Can you comment on that a little bit, William?
Certainly. When you invest in the stock market, you should diversify by not buying stocks in only one company. You should buy at least 20. And if you buy an index fund or an ETF, an exchange traded fund of the index, of the S&P 500 index, that aggregates 500 of the biggest and most successful companies in the United States, you are plenty diversified. That index would be able to protect you against problems that one particular company might encounter. Individual companies, they start off, they grow very fast. Sometimes they mature and they can be successful for many years. and eventually they can also decline or even go out of business. But the index renews itself. The S&P 500 index has 500 of the biggest companies, and as new companies emerge and become bigger than the 500th company in the index, then they displace them. And a company that might have been in the middle of the index and then starts losing money and going out of business, once it drops, the index will drop it. It's very telling that, for example, another index, the Dow Jones, started in the 1800s, and it originally had like 15 companies. Now it has 30, but none of the 15 original companies are there now. These were railroads and steel companies in that period that were very successful, even today. So the index renews itself. And so it helps diversify for the small investor and the beginner investor, even for the most experienced investor. If you buy the index, you are plenty diversified.
Beautiful, 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 Willie. All right. Let's go to the power of what? The power of investing. Now, again, how can you have financial freedom? How can you be wealthy? And remind you, wealth is not a bad thing. I often tell you cannot give what you don't have. And it says a good man leave an inheritance for his children. Nothing wrong in leaving something for your children. Nothing wrong in having wealth where you could bless people. Like I said, I did a video on understanding money. Money is not evil. It's the love of money is the root of all evil. Money can dig a well in a poor third world country somewhere around the world. Money can help orphans. I mean, we really do. And so even in the Bible, I think it's the second most mentioned subject. It's money. So people get turned off by money. It's amazing. But if we talk about the power of investing and how can you really be wealthy is, I'm not knocking a 9-to-5 job. You could have a 9-to-5 job and, you exchange hours for dollars and time for money. But real estate, man, real estate is so powerful. You could buy a house and it could quadruple when time to sell it because of its appreciation and so forth. Then you could start a business. Starting a business is a way to really, really knock it out of the ballpark. Take, for example, Apple with Steve Jobs, or even Tesla with Elon Musk. Starting a business, whether it's a restaurant, whether it's a landscaping company, whether it's a beauty salon, starting a business gives you leverage. And the other way you can become financially free or wealthy is by investing in the stock market. And so let me say this, that investing in the stock market now has been made available to the common man. And you can invest now in M1 Finance, Robinhood, Webull on your phone during lunchtime. You could invest, you could buy and sell stocks. It wasn't so years ago. And let me say this, like people who came from the islands and from third world countries or South America or Africa or whatever, we came here to fulfill the American dream. And we were hardworking people. We would buy a house, we will send our children to college, we'll take out loans, and that's it. But coming to the stock market, it was like something foreign to us. Look, I'm a late bloomer. I really started investing in individual stocks a year ago, although I had a mutual fund and an IRA or whatever. But investing is like, wow, no. So I want to bring awareness. I want to add value to people and let them know, man, you can do this. You can do this. So, you could also be wealthy if you're a basketball player, but that's 0.1%. Or you could be a Beyonce. That's be an artist or whatever, a movie star. That's very minute. But these are fundamental ways where you can invest: the real estate, start a business, or the stock market. All right. Now tell us about the stock market. Some people say, "Oh, it's gambling." Oh, I don't understand it. Or people lose money. And there's so many myths and misunderstanding about that.
There are, and let me just say before going into the stock market that owning your own home is probably the biggest investment that most people do. If you're renting, try to purchase your own home. And it's not only a good investment, but it's a place to raise your family, and that's priceless. And by paying your mortgage, you accumulate wealth with the appreciation in value and with the reduction in the mortgage that you do.
And what about tax write-off? Will you get tax write-off also?
Yes, I'm just saying, if you buy real estate just for your own home rather than for rental properties, investing in rental real estate takes a lot of money to begin with, and investing in a small business, it takes a lot of risk and a lot of money. But to invest in the stock market, you can begin with $100. How can it be easier than that? You just open a brokerage account. If you have a job that has a 401k, start up to participate in the 401k and begin investing in a stock market fund. Don't put your money in bonds. Don't put them in cash. The perception that a lot of people have about the stock market is that it's a risky proposition. They think, well, prices go up and down, and in order to be able to invest successfully, you have to know when to buy, hopefully at the low point, and when to sell, hopefully at the high point. But this is not the reality. The reality is that the stock market, the prices go up and down, sure, but over time, this is the time here, the prices really go up over time. They don't stay the same. So it really doesn't matter. You don't need to know when it's a good time to buy. You could buy at the highest price in this year, and over time, the prices will be higher. And this is, of course, a theory here, but the reality is right here. This is what the actual S&P 500 index has done over the last 50 years. If you had invested $10,000 back then, you would have today over $1.2 million in your retirement account. And so even if you bought at the worst possible time in the peak of the dot-com bubble here, you would still be way ahead. So it goes up over time, although there is volatility. And that's a perception, a misconception that I tried to clarify on this book. This book, the main message is that stock prices go up over time because they reflect the increased value of the economy. If the economy grows over time, the stock prices rise over time. And a lot of people don't know this. And a lot of people think that the stock market is a casino and it's risky and you don't know what to do, what to expect. But it's true that in the short term, nobody knows what's going to happen. In the short term, it's impossible to tell. But in the long term, it's easy to know that prices are going to be higher 20, 30, or 50 years into the future.
So true. Willie, they said for the past 100 years, the stock market goes up on an average of 10% annually. So whether it's a bubble, whether it's a pullback, whether it's a dip, whether it's a correction, whether it's a bear market, whether it's a bull market, whether it's a recession, on an average of every year for the last 100 years, and the trend is your friend. You can't go wrong with history. So look what happened 2 weeks ago, Brother Willie. People were going crazy. Oh my God, the market is going down, it's red, I'm losing money. Oh my God, what to do? You don't have to panic. You press, you pounce, and you pray. P-R-E-Y. You pray. You buy. That's the time you buy. Yeah. So when people don't know, my people are destroyed for lack of knowledge. When people don't know, unless millionaires are being made every day in the stock market, yet people can lose money too. But why not get in the game? Why? Listen, the man who didn't invest the talent, he was not rewarded, Maybe he was good. As a matter of fact, he probably was sincere, hardworking. He dug a hole. It takes energy to dig. But because of fear of risk, he did nothing, and he ended up with nothing. So I'm not knocking savings, but I'm saying investment is the way to go. You can't beat it with a thing. And the Bible said it. This is a parable from Jesus himself. One of the most empowering parables in the Bible. How a man doubled his earnings by making 100% profit. And he was rewarded immensely. He got promotion and everything. I'll go into that in another day. But let's move on. And let me say this, Willie, can you tell them what's the name of your YouTube channel so people can subscribe?
Yes, it's Finance ABCs '. It's I'm trying to dedicate it to the basics and to really teach people that that are new to investing the basics and how to save successfully for their retirements. Finance ABCs. So.
All right, thank you, Uli. Let's move on quickly because of time. Because in the end, we'll have some questions, Q&A, right? So you can ask your question and so forth. All right, let's go to this. All right, what is the stock market? What is the stock market? What is, Brother Ro, what's the stock market? What's the stock market? It says the stock market is where investors connect to buy and sell. You buy and sell, basically. You buy and sell investments, most commonly stocks, which are shares of ownership in a public company. All right? Now, there are three indexes, and Willie was talking about it a while ago. In the United States, the S&P 500, there's 500 of the largest companies, and the Dow Jones 30 company, the NASDAQ 100 tech company, and so forth and so on. The three most broadly followed indexes by both media and investors. So you look at CNBC or you look at all these different things. They're telling you about it. Today, the Dow Jones Industrial Average went up so and so, and the NASDAQ is at right now in the correction territory, and the S&P. These are what you hear. These are the main indexes. All right. And so when you buy a share in a company, now I could go and eat in McDonald's, but I don't own anything in McDonald's. I could buy an Apple phone. If I'm not invested in Apple, I don't own anything in Apple. But when I buy a share, I become a shareholder. I am a part owner of that company, no matter how minute it is. And when that company does well, I do well. So investing in good companies, man, and you can, Willie just said it, you can buy a fraction of a share. Let's say you want to buy in the SPY, the SPY. That's the S&P. You say, Brother Ro, it's $300 and something a share. That's too much. You can buy a fraction of a share. And the S&P over the years goes up and up, regardless of a bear market or correction. You know, so when I take a American airline and I sit there, I'm a part owner. When I go into Apple store and I buy an Apple iPad or whatever, I'm a shareholder. Now, some companies, they just growth companies, but some companies, they pay you a dividend. Every 3 months, I'm getting money. And it might sound like pennies, but that adds up because what happened to compound interest? You reinvest your dividend, and we're going to get to that. There's so much to cover today, Willie, but tell us something. As a young investor, I did most of my investing in individual stocks. And we all know, look, Warren Buffett, the greatest investor in this century, he sold his airline stocks, and right now they're above the price that he sold them for. So nobody gets it right 100%. Like Willie said, a mistake is only a mistake when you learn from it. So everybody's going to learn and grow. All right. So tell us, Willie, about the stock market, and you are smart, man. You invest in the SPY, and how much percentage are you up? I'm not going to ask you how much shares you have in it, but I know you're doing very well.
Well, I tell you, I have been investing for a long time. I wish I had known what I know today when I was in my 20s. Let me tell you this, the stock market, the S&P 500, in the last 50 years has been down 17 times more, between 10% to 20%. That's a correction. 17 times it has been down, but only 7 years the market has ended lower than it began. So those correction periods are intra-year, temporary. They recover. even last year, 2020, the market went down 30%, the S&P 500, 30% in March, down, but the S&P recovered and ended the year actually up 18%, including that down, that drop of 30% in March. So, like Lucian says, it's good not to panic. It's good to pray and to press, like he says, and just stay the course. If you continue to buy every month in your 401k, the index, your money will grow over time, compounding. Because the times that it drops, it will give you an opportunity to buy more at a lower price on average time.
You know, Willie, in 2007, 2008, when they had the housing crisis, and that was a bear market.
Yes, it was.
At the time, I was working for sanitation, and my portfolio in 2008, I think I had about $100,000 in the year at the time. It dropped to 46,000. It dropped to over 50%. But my 401k was putting money every week, regardless of the drop. You know, in 2 years, I recovered all. And I mean, by the time I retired, it was probably quadruple. So you don't panic when the market goes down. And that's what people do. Another thing, really, people that are new to investing, like most of my subscribers, they're young investors, and I'm new too. They're new to it. And what happened? People end up buying, Willie, penny stocks. They say, oh, I'm going to get a cheap one. I'm getting the cheap one. This one is good for $2. Buy this. This one is good for $3. And some of these companies go out of business. You buy fundamentally sound companies, or like you said, if you don't know much about buying, you say, Brother, I'm new to this. I'm confused. I don't understand stuff. I don't know what to buy. The safe bet is ETFs. The safe bet is index. The safe bet, because why? You're not putting all your eggs in one basket. Remember the scripture that I read in Ecclesiastes. Invest in different places. Ecclesiastes 11:2. Invest in different places. So if you invest in the Standard & Poor, the S&P, you are invested in 500 companies. Like I was big on the QQQ. Will you know that? I was big on the QQQ. That's the NASDAQ ETF. And I hope we're not being confused. We're going to break it down and explain it. But now tech took a beating, and I'm done big time. And I learned from that. High risk, high reward. But I now is going to trim my portfolio and even diversify it more. All right. So, Willie, let me just go to this slide and I'll ask you to comment on this one. Okay. Let's go here. Now, there are 11 sectors in the stock market. 11. All right, the 11 sectors in the stock market. And I hope we're not confusing you this morning. It's not 11 sections. 11 sections in the stock market. All right, and in no particular order: energy, material, industrial. All right, energy is like refineries. ExxonMobil is in the energy sector. Material is like mining. That's like copper. And different things where you mine gold, whatever. Forestry, they need a lot of forestry, lumber for building houses and for making paper. And then you have industrial, like it's aerospace defense, like Lockheed Martin. They make tanks, they make planes for the military. And you know the budget of the military is like Caterpillar. I invested in Caterpillar, and my God, it's doing really good. Then we have consumer discretionary. Consumer discretionary. That's like retail apparel companies. Let me say this quickly, and I'll let Willie comment. They have consumer staple and consumer discretionary. Consumer discretionary is like luxury goods. When the economy does well, consumer discretionary does well. So this consumer discretionary took a beating for the COVID-19 in March. In April, it was doing, because why? Nobody's going to a luxury resort in Dubai. Nobody is buying Rolexes, and nobody's buying BMWs and Mercedes-Benz for the most part. Because those are, when the economy is doing good, people invest in those things. But when there was a pullback, a dip, unemployment, businesses shut down and so forth. But you know what? What was a defensive stock? Consumer staple. Consumer staple is like food and beverages. So what happened during the pandemic? I remember going to Costco. Brother William, I remember going to Costco. The line was wrapped around, I'm not exaggerating. And there was only one bill of toilet paper for family. And 3 hours you got a line. I said, I can't do this. I turned around and went to Key Foods or whatever. But Costco, Walmart, Target, because the groceries were open when everything else was closed in the pandemic, they was doing good. So consumer staple, whether it's a bull market, bear market, pullback, recession, people have to eat. As a matter of fact, they was inside, most people gained weight, they were eating. So consumer staple did well, but consumer discretionary was hurting. Then we have health care, biotechnology, hospital. People will always get sick. You need, listen, see what happened with COVID-19 and medical devices and so forth. Moderna, Pfizer, Johnson & Johnson. All right, then we have banks. Banks are coming back. JP Morgan, Bank of America, Wells Fargo, lending institution. That's financial. Then we have information, IT, information technology, electronics, software, Microsoft. All right. These are, then we have telecommunication. What is it? Internet provider services. We have what is telecommunication, Willie?
T-Mobile, Verizon.
T-Mobile, right, yeah. Right? And I invest in T-Mobile, I invest in, we'll talk about that in terms of dividend paying. Then we have utility. Utility also withstand any bull market, bear market, recession, because you need light and gas. You need gas. So we have companies like Duke Energy and so forth and so on, and gas companies, Con Edison and so forth. And then we have real estate. That's called REIT, R-E-I-T, Real Estate Investment Trust. See, I cannot buy Green Acres Mall, but I can buy a part of Green Acres Mall by investing in O Realty. O is a company, and you could buy a piece of that. Macy's don't own Green Acres Mall; they rent from Green Acres Mall. So these residential and industrial real estate, they buy big strip malls like Walgreens rent from them, CVS rent from them. So when you buy into that, I need millions of dollars to invest in that, but I could invest by buying in real estate, REITs, and they pay a dividend monthly. All right. So Willie, can you for a minute talk about that for us in the 11 sectors? And every sector, by the way, every sector has an ETF. ETF is an exchange traded funds. There's more than one stock in an ETF. So you're not buying one individual stock. And tell us the dangers of buying one stock, which I buy too, everybody does. Because you catch a stock when they went IPO, you could take it to the moon. If you bought Tesla at $17 a share when Tesla went public in 2010, my God, Tesla made millions. But tell us the danger, like Blockbuster, Toys R Us, that went out of business. You are safer with an ETF than an individual stock. That doesn't mean you shouldn't invest in an individual stock. Like Apple is a good stock, Facebook is a good stock. So talk to us about that, Willie. And you told us about some companies that went out of business.
Certainly, the S&P 500 index has all those 11 sectors that you discussed. And you're right that at times, one sector is going to do better than another. And it sometimes is logical to anticipate that, but at other times it's difficult, and that's what they call timing the market. You can time the market by buying individual stocks that you think are going to do well, or individual sectors. But if you really don't have to do that, you can just own the entire S&P 500 index. And let me tell you briefly about mistakes when investing. And I tell you, I have done them all, and I have learned from them. The first one, of course, is trying to time the market. This is what I've been saying. It's very, very difficult. You know, the stock market has had 17 declines of more than 10%, but it doesn't end the year down. Only 7 years have that has happened. In fact, only 8 years. In 8 years, within the year, the stock market has gone down more than 20%. That's a bear market definition. And last year it went down 30%, but then it ended up. At the end of the year, it was up. So timing the market is hard and it's difficult and it's not necessary. You don't have to do it. Not being diversified is the second mistake. But if you buy an index, then you take care of that. Being overly conservative is a very, very big mistake that a lot of people in the beginning do because they're not certain, they don't understand. And so they buy bonds or they buy cash, which yield a lower return annually than stocks. So if you're beginning and you're in your 20s and you have 50 years to go, put it all in the S&P 500 index, and you will do much better than having what they call a balanced portfolio. And the last mistake is not starting early. That's if you don't start early, you don't have the time for their money to compound. And you don't really need to start with a lot of money. Only a little bit, $100 a month is enough. You don't need to do complex math. You don't even have to be very smart. If you just put $100 a month in the index, and you have the stomach, the guts, to see this volatility, this market volatility. I mean, it's unsettling to see your investments go down 20% in value in 1 month or more. But if you can just stay the course and continue to invest, you're going to do very, very well. Believe me, it will happen for you.
Wow, that's really amazing. That's really amazing. Wow. So, Willie, we are going through right now a decline, and my portfolio took a beating, and I think it was yesterday, Friday. I was getting a little nuts in my stomach because I said, look, I'm going to turn off the TV because it opened up high, it went down low, and then by the evening, I mean, it was over 500 points. So somebody once said, it's not time in the market, it's time spent in the market, because you want to sell when it's low, you want to buy when it's high. It's going to get you. It's going to get you. They say the best investors in the world cannot time the market. You set it and forget it.
That's right.
That's why I like to go long term. Look, and you might say, I don't know about the stock market. I don't want to invest in what I don't know about. If you invest it and leave it, it's going to grow. History says it. I was talking to a friend of mine. He invited me to have a steak, my wife and I, during the summer. And his son had gotten like $14,000 from not the stimulus, but the unemployment, whatever. And he said, son, take 1,000 for yourself, take the 13,000 and throw it in the stock market. And he says, guess what? Buy Tesla. It wasn't ETFs, but he said, buy Tesla, buy Apple, buy Facebook, buy Microsoft, buy this thing. And he said, leave it. He says, within the year, it had doubled. So he was a 21-year-old that didn't know much about investing, but he just threw it in the market. But he bought quality stocks, though, quality companies. And that's what happened. Now, I am learning from you, William, because now I understand even more so how to invest and to diversify my portfolio in terms of not putting all my eggs in one basket. I usually draw a scenario. If you have 100 eggs in one basket and that egg fall off the table, that basket, all those eggs can be lost. Now, if you have 10 baskets with 10 eggs each, and one basket fall, you still have 9 baskets with 90 eggs. You still have 90%. If 2 baskets fall and crush, you still have 80%. So that's why it's important to diversify one's portfolio. Ecclesiastes 11:2, invest in different places. Now, tell us some of the good things that can happen when you invest in an individual company. Of course, you have to do your technical analysis and your technical analysis and your fundamental analysis. But what can happen if you invest in an individual stock and you put all your eggs in that stock, what can happen? You draw the scenario about companies that went out of business.
That's right. Like you said, Toys R Us is an example, a great company, leading in its industry in toys. And it was a retailer, and it went out of business, unfortunately. Woolworths was a leading retailer in its time, and it went out of business too. Pan American, the leading airline in the world, went out of business. The airline industry is still happening. There's still a need for it, but the biggest company in its time went out of business. It's risky to invest in individual stocks. Like Lucian says, diversifying and investing in different companies or buying an index is a better way of safeguarding your savings. And also by investing a little bit of money every month, you are diversifying your entry point, because you could have the unfortunate timing of purchasing at the very top, and then when there is a drop it can happen anytime, then you get discouraged because you see the paper loss. But by investing every month a little bit and continuing to live your life as ordinarily as you would with your 9-to-5 job or with whatever you're doing, then in the end, the time will pass and your money will compound. And when the time comes for you to retire, you will have your money there for you.
Okay. William, are you able to see my screen?
Absolutely. Yes.
Okay, good. Now, let's talk quickly, because some of the new investors, people are panicking. People are calling, oh, what to do? It's all red. So look, we want to talk about a correction versus a bear market. And people said, the investors says that it's a correction is even healthy. That when the market is corrected, because life is not ups and ups and ups and ups, there are ups and downs. So when it's down, that's when you hold, or you don't panic, but you buy. So the general definition of a market correction is a market decline that is more than 10%, but less than 20%. A bear market is usually defined as a decline of 20% or greater. Past bear markets have always been shorter than bull markets. On March 11, 2020, the U.S. entered into a bear market for the first time in 11 years. The Dow Jones Industrial Average went from almost 30,000 to under 19,000. This was brought about by the spreading of the COVID-19 pandemic. So that was a bear market, and since then it has certainly recovered. So that's a beautiful thing. And so it's also important to diversify our portfolio, and we should not panic during those times. All right. So what do we do, William? It says here the importance of diversifying your portfolio. It is one way to balance risk and renew your investment portfolio by diversifying your assets. Diversification is the practice of spreading your investment around so that your exposure to any one type of asset, we talk about 11 sectors, is limited. This practice is designed to help reduce the volatility of your portfolio over time. All right. And last but not least here, we don't panic. I said we don't panic. We press and pounce. We pray. P-R-E-Y. We pray. All right. Hear what Warren Buffett says, one of the greatest investors. He said, be fearful when others are greedy, and greedy when others are fearful. When everybody's telling you buy. That simply means to have the courage to step in and buy when others are selling, and be cautious when others are overly greedy. In fact, 80% of corrections, like you were saying earlier on, William, do not turn into a bear market. That means only 20% do. History shows that staying calm, having a solid plan, and a well-diversified portfolio is the best option for savvy long-term investing. All right. So what we want to do, Willie, you want to comment on that, and then we're gonna take some
questions.
Yes, some questions.
Yes, certainly. I think you said it perfectly there with the caption, "Don't panic." Because the economy in our country, we're blessed that it grows over time, and it doesn't grow in a straight line. It grows in fits and starts, and it's uneven, and so that creates waves in the securities markets. So over time, the direction is up, and the economy normally grows, and the government helps. Now with the stimulus that is being approved and the vaccines that are being distributed, the pandemic is going to be controlled, and so the reopening is going to happen. So this year, most likely the economy is going to grow substantially. Sure, there's going to be a risk of inflation. There might be a risk of higher interest rates, and there might be risks that the reopening is not even. Sometimes the lockdowns have to be put back in place to control outbreaks. But I think the risks are small, and over time, the direction is going to be higher.
All right, beautiful. Before we go into Q&A, we want to do some quick Q&A, question and answers, and no questions is stupid or foolish, William. You might be a young investor, and I like to ask questions. That's how you grow, and that's how you learn. Before we go into the Q&A, I just want to show you something here. Because of the pandemic, there are certain industries that suffered immensely. Some of them, we consider them what you call value stock, because they are at a discount now. Because when the economy opens up more, I should say fully, but more, you take into consideration. Now, most of the market, it goes by news and speculation. They say you buy the rumor, you sell the news. Now, for example, if Janet Yellen says something, the market will go up or down, right, William? If the Fed chairman, Powell, says something, look, just recently, Elon Musk bought 1.5 billion in Bitcoins, and Bitcoin went up. So the president, Joe Biden, can say something, and the market can shift. So the market goes on speculation and so forth. So, so that's important for us to understand that. So because of the fact that the vaccine, I took the shot, I have another shot coming at the end of the month. Because of the vaccine, even Johnson & Johnson just came up with another vaccine. Because of the vaccine and the stimulus and what we call pent-up demand, you might be surprised. People are ready to travel. So the airlines will come back, the casinos will come back, the cruise lines will come back, and what else? Cruise line, casinos, hotels, and restaurants will come back. They'll come back. So I just want to quickly, if I may share this here, I want to go into my portfolio quickly. Can you tell me if you can see it, Will?
Yes, I can see it.
All right. We want to look at four areas quickly, and we're going to look at the SPY. You talk about diversifying, right? Let's look at airline first, right? We're going to do airlines. I'm going to take an airline, Delta. How many ever traveled with Delta before? How many have Delta mileage? Delta, right? And then we're going to go to Q&A. Look at Delta. For the past, target, all right. You see around here, if everybody could see this. January 17th, 2020, last year, before the pandemic hit, Delta shares was going for $62.03. When the pandemic hit, everything dropped. Every stock dropped like a rock. By the time the pandemic hit, May 15th, Delta was going for $19.19 a share. Delta lost over 2/3, 66%. Now, what do? Do you panic? Do you sell? If you hold Watch this. You hold right now. Delta is almost back, and the market is not fully open yet. $47.94. It's close to the high of $62. So that's the beauty of holding and not panicking and selling. So Delta is a value stock. Airlines are coming back. You know, United Airlines just ordered, I think, 26737 from Boeing. All right, so that's airline. Let's look at cruise. Our Royal Caribbean. Let's look at Royal Caribbean quickly. Royal Caribbean. Royal Caribbean. I cruised in January for my birthday, Willie, last year, just before the pandemic. Royal Caribbean in January last year was going for $133.19 a share. Pandemic came. Boom. It went down to $28. Can you imagine you buy 1,000 shares at $28? What is it going for now? $78. It would have tripled. So you buy on the dip, you buy on the low, and you hold on the dip. If you don't buy, it will recover. History says it. So now Royal Caribbean is $93 a share. It's almost back to its high. And by summer, it may be when they start cruising. Of course, they want you to have a vaccine before you cruise. Let me do two more, Willie, and I'm going to start the Q&A. What did I talk about? What did I talk about? Airline and cruise. Let's go to hotels. Marriott, one of the largest chains in the United States. M-A-R, Marriott. What Marriott was trading for during the just before the pandemic? $150 a share. Pandemic came, all the hotels closed. Nobody was staying in hotels. Everybody was scared. Everybody staying home. There was a lockdown. It dropped to less than half. Look what happened now. $146 a share, close to 150, right? And could you imagine the summertime what's going to happen?
Yeah.
Last one but not least, let's look at casinos. Casinos were shut down during the pandemic. Let's look at Las Vegas Sands quickly. How much was that trading for just before the pandemic? $74 a share. Boom! COVID came, and the thing dropped like a rock to $37 a share, less than 50%. If you had held it or you bought down here, dollar cost average, like you said, Willie, right now it's up to 62. It's almost to the high. But these are individual stocks. Let me go to Willie's favorite indexes. The SPY. And then we'll take question and answers. SPY. Now, that's the S&P, William, and the S&P was trading before the COVID at $322 a share. You say, but William, Brother Rowe, that's too much. I cannot afford it. You can buy a fraction. You can buy $100 every month. It's safe. Forget these penny stocks that you don't know about. Now, watch this. It went down, did it? During the COVID, everything went down, right? It went down to $228 a share. $228, right? It dropped. But if you had bought here or you had hold it, look what happened. It surpassed the high of $337, and now it's trading for almost $400 a share. That's the beauty of investing in 500 companies. So if Apple goes down, they have 499 companies to carry it. So I would say to the new investor, invest in ETFs or invest in indexes. It's diversified and it will cover you. What say you, Williams?
Yes, you're 100% right. And exactly, my favorite way to diversify is buying the ETF, the S&P 500. And it's very hard to know when the low is. But if you buy every month, you're likely to buy when it's up and when it's down. and your average cost is going to be good for a buy and hold investor. You don't need to know when the low point is. You just buy every month, and eventually you will buy some at the low, some at the high, some in the middle, and over time it will continue to go up, and you will do very, very well.
Right. Very, very, very good. Now we want to take some questions.